There's a trader I know, 2 years in the market, 68% win rate, has a system, follows his rules. Last year, he blew 80% of his account in 3 weeks. Not because his analysis was wrong, because of one thing that most trading content never teaches you. You can read charts well, you can enter correctly 7 out of 10 times, and still lose money, consistently. I've watched this happen more times than I can count, and the reason is always the same. Today, I'm putting the complete money management system on the table, from how to size your positions to how to protect your account during losing streaks, to the psychology that destroys traders who know all the right rules. One video. Nothing left out. And in about 10 minutes, I'll show you a number that your trading system must be able to survive. A number most traders never calculate until it's already too late. Let me give you a scenario. Trader A wins 7 out of every 10 trades. By most people's standards, that's an excellent win rate. He has a real edge in reading the market. But here's what his trade journal actually looks like. Every winning trade, he makes about $50. But every losing trade, he loses $500. After 10 trades, 7 wins and 3 losses, let's do the math. 7 wins at $50 is plus $350. 3 losses at $500 is minus $1,500. Net result, he's down $1,150. He's losing money despite being right 70% of the time. This isn't a hypothetical. This is what happens when a trader obsesses over win rate and ignores everything else. He's technically skilled. His analysis is sound, but the way he manages each trade is destroying him. Here's the real issue. Most traders think about performance like this. I just need to get better at picking entries, more screen time, better indicators. Technical analysis, your entries, your zones, your setups, that's the input. It's important. But money management is the engine that processes that input into actual results over time. You can have the best input in the world. If the engine is broken, the output will always be negative. And here's the mistake that breaks the engine most often. Sizing up when you feel confident. Sizing down when you feel uncertain. This sounds completely logical. In practice, it's the most dangerous habit a trader can have. Your conviction level on any given trade is not a measurable variable. It changes based on your mood, your recent results, how much sleep you got. The market doesn't care about any of that. The size of your position must be determined by one thing only: how much you're willing to lose if this trade is wrong. Not how right you think you are. The difference between a trader and a gambler isn't the analysis. It's this. The gambler sizes up when they feel it. The trader sizes based on a formula. Every single time, regardless of how they feel. To build that formula, you need one thing first. A standardized unit of measurement, something that removes dollar amounts and percentages from your thinking, and replaces them with a single clean variable. Every professional trader uses it. And once you start thinking this way, you can't go back. It's called R. R stands for risk. It's the maximum dollar amount you're willing to lose if this trade goes against you. Here's a concrete example. You have a $10,000 account. On this trade, you decide the maximum you're willing to lose is $100. That $100 is your R. That's 1R. Now the trade plays out. You exit with a $200 profit. That trade was plus 2R. You hit your stop and lose $100. That trade was minus 1R. The dollar amounts will change as your account grows or shrinks, but the R framework stays exactly the same. 1R is always the unit. Everything else is a multiple of it. Why does this matter? Because it removes the emotional weight of money from your decision-making, and that's more powerful than it sounds. Think about these two statements. Statement 1, I just lost $2,000. Statement 2, I lost 1R. The first one triggers a stress response. It makes you want to do something. Trade back, revenge trade, increase your size to recover. The second one is just data. It's information about how the system performed, nothing more. When you think in R, you can evaluate your trading objectively, not emotionally. And that objectivity is what allows you to stay consistent, which is the only way a statistical edge actually pays out over time. Here's how to use it in practice. Start a trade journal. Every single trade. Record your entry price, your stop loss, and your exit. But write the result in R, not in dollars. After 20 trades, you'll be able to see your system clearly. A string of losses looks devastating in dollar terms. In R terms, it's minus 0.8, minus 1, minus 0.9. 3 trades, 3 data points, recoverable, manageable, something you can actually learn from. A string of wins that feels like genius looks different too. Plus 1.2 R, plus 0.7 R, plus 2 R. Your edge is working, not your intuition, not your confidence. The system. Now we have our unit, R. And we can use it to answer the most important question in trading. Not, will this trade win? That's the wrong question. The right question is, over the next 100 trades, does this system produce a positive average result? That average result has a name. It's called expectancy, and the answer will probably surprise you. Expectancy answers one question. If I take this exact trade setup 100 times, what's my average result per trade? The formula is this. Expectancy equals win rate multiplied by your average win in R, minus loss rate multiplied by your average loss in R. If that number is positive, your system has a mathematical edge. If it's negative, no amount of discipline or money management will save you. The system itself is broken, and you need to fix it before anything else. Now here's where most traders get a surprise. I want you to look at this table. On one axis, your win rate. On the other, your reward to risk ratio. The number inside each cell is your expectancy per trade. Find your win rate. Find your typical reward to risk. Look at the number in that cell. Take a trader with a 40% win rate running a 1-to-2 reward to risk ratio. Expectancy, plus 0.20 R per trade. That's a real positive edge. Over 100 trades, that system produces 20 R of profit on average. The same 40% win rate at 1-to-1? Negative 0.20 R per trade. That trader is losing money. Slowly, consistently, no matter how disciplined they are. Here's what most people miss entirely. A trader with only 30% win rate, losing 7 out of every 10 trades, running a 1-to-3 reward to risk ratio, has a positive expectancy of plus 0.20 R. That trader is profitable. And a trader with 60% win rate at 1-to-1, also plus 0.20 R. Same edge. But the 30% win rate trader wins less often, catches bigger moves, and sits through more psychological discomfort to get there. Both systems work. The math doesn't care which one feels better. What this table tells you is simple. Your win rate alone means nothing. Your reward to risk ratio alone means nothing. It's the combination of the two that determines whether you make money over time. Find your position in this table. That number is the honest answer about your current system. If it's positive, you're ready for the next step. If it's negative or zero, that's the most important thing you can learn from this video. Stop optimizing entries. Fix the ratio first. Once you've confirmed positive expectancy, one question remains. How much should you risk on each trade? The answer is more precise than most people think, and it has a formula. This is the formula you'll use for the rest of your trading career. Position size equals account size multiplied by risk percentage divided by stop loss distance. That's it. Let's walk through it. Your account is $10,000. You've decided to risk 1% per trade. That gives you $100 of risk for this trade. Your stop loss is 50 points away from your entry. And let's say each point is worth $1 per lot. So $100 divided by $50 equals 2 lots. Now your stop is further away, 100 points. Same account, same 1% risk. $100 divided by $100 equals 1 lot. Notice what happened. When the stop was further, the formula automatically gave you a smaller position. When the stop was tighter, it gave you a larger one. You didn't have to think about it. The formula adjusted. That's the entire point. This method is called fixed fractional position sizing, and it has 3 properties that make it the standard for professional traders. First, as your account grows, your position size grows with it. Your 1% risk on a $20,000 account is $200 instead of $100. You're compounding gains naturally without ever needing to consciously increase your size. Second, as your account drops, your position size automatically shrinks. You're risking fewer dollars during a losing period, which protects what's left and gives the system time to recover. Third, you never have to make a sizing decision in the moment. The formula makes it for you. And that means one less decision that emotion can contaminate. Imagine two traders, same system, same trades, same win rate. One uses 1% risk per trade, the other uses 5%. After 50 trades, their equity curves look completely different. The 5% trader might have had a great run, or might have hit a bad streak and lost 40% of their account before the system could recover. The 1% trader is still in the game either way. Risk 1% and you'll almost never blow an account. Risk 5% consistently and you're always one bad month away from a significant setback. One critical point before moving on. Your stop loss must be placed at the correct technical level, not at a fixed percentage, not at a round number, not where it's comfortable. A stop placed wrong means your distance is wrong, which means your size is wrong, which means the formula produces the wrong answer. Technical placement comes first. The formula comes second. There's a second model worth knowing. It's called the Kelly criterion. The formula is F equals B times P minus Q, all divided by B, where B is your reward to risk ratio, P is your win rate, and Q is 1 minus your win rate. For a 45% win rate system with a 1 to 2 reward to risk, full Kelly comes out to 17.5%. That means risking 17.5% of your account per trade. In theory, that maximizes long-term growth. In practice, it will destroy you psychologically and mathematically during any normal losing streak. What professionals actually use is quarter Kelly, 4.4% in this example, and most conservative systems stay at or below 2%. Think of full Kelly as a theoretical ceiling, not a target. One final note for traders using leverage: futures, forex on margin, crypto perpetuals. The formula is identical. Leverage changes how much margin your broker requires to open the position, not how much you actually risk. The only additional check: make sure your liquidation price is further away from your entry than your stop loss. If it isn't, reduce your leverage until it is. Here's the math that most traders never look at directly. When you lose money, you don't just need to make back what you lost. You need to make back more, because the math works against you on the way down. Lose 10% of your account. You need to make 11% to get back to even. Lose 25%. You need 33%. Lose 50%. You need a full 100% return just to break even. And if you lose 75% of your account, you need 300% to recover. The formula is 1 divided by 1 minus the drawdown percentage minus 1. That's your required return. This is why drawdowns are not linear. They're exponential. A 25% drawdown feels manageable. A 50% drawdown is a completely different mathematical situation. And a 75% drawdown, for most retail accounts, is effectively terminal. This is the fundamental argument for keeping your risk per trade small. Not because small is timid, but because surviving a bad run is the only way your edge ever gets to pay out. Now, the number I mentioned at the beginning of the video. Most traders never ask this question. How many consecutive losses should my system expect to hit? Here's the answer. A system with 50% win rate. After 100 trades, you will hit a streak of 6 to 7 consecutive losses. Not might, will. It's statistically expected. A 40% win rate system? Expect 8 to 10 losses in a row at some point in every 100 trades. Ask yourself this question honestly. If I hit 8 losing trades in a row, what happens to my account? What happens to my psychology? Can I keep following the system? If the answer is no, then no amount of edge will save you. You'll abandon the system right before it recovers. This brings us to risk of ruin. The probability that your account drops to a point you can't recover from. At 1% risk per trade, your risk of ruin is effectively 0, even accounting for normal losing streaks. At 2%, it's still near zero. At 5%, it's around 4.5%. At 10% risk per trade, the probability of blowing your account approaches 21%. 1 in 5 chance of ruin, just from sizing too large. Keep your risk under 2% per trade. That's the line. Below it, losing streaks are painful but survivable. Above it, one bad month can end your trading account. There's one more control mechanism worth building into your system. When you're in a drawdown, reduce your size. If your account is down 10% from its peak, drop your risk to 1.5%, down 20%, drop to 1%, down 30%, stop trading entirely. Step back, review the system, and only return when you've identified what changed. This isn't weakness. This is the most professional thing a trader can do. Preserving capital during a rough period is what lets you still be in the market when conditions improve. The formula keeps you alive. This mechanism keeps you rational. Every trader knows they shouldn't move their stop loss. Every trader knows they shouldn't double their size after a bad loss. Every trader knows they shouldn't chase a move they missed. And most traders still do all of these things. That's not a knowledge problem. That's a psychology problem. And psychology is where perfectly good systems go to die. There are 4 biases that destroy money management from the inside. The first is loss aversion. Research shows the pain of a loss is roughly twice as powerful as the pleasure of an equivalent gain. What this means in practice, you hold losing trades longer than you should, hoping they'll come back. And you cut winning trades earlier than you should, afraid to give back the profit. The result is your average loss gets larger than your average win, and your expectancy slowly turns negative, even when your entries are good. The second is overconfidence. After a run of winning trades, your brain starts to believe you've figured something out. You increase your size at exactly the wrong moment. And one bad trade, which is statistically inevitable, wipes out multiple winning trades before it. The third is revenge trading. You take a loss, and the immediate emotional response is to want it back. You enter the next trade without a clear setup, just urgency. That trade isn't an edge. It's a coin flip with extra steps. The fourth is FOMO, fear of missing out. Price moves without you. You chase the entry late. Now your stop is further away than it should be. Your size is wrong because the formula uses the wrong distance, and the entire trade is structured incorrectly before it even starts. The solution isn't willpower. Willpower fails under pressure, under fatigue, under a losing streak. The solution is a system that removes the decision entirely. 3 things you can implement today. First, the 30-second rule. Before every single trade, answer 3 questions out loud or in writing. What is the setup? Where is the stop? What is the position size? If you cannot answer all 3 in 30 seconds, you don't enter. Not because the trade is necessarily wrong, but because you're not ready to take it properly. Second, bracket orders. The moment you enter a trade, place your take profit and your stop loss simultaneously. Don't give yourself the option to move the stop when price gets close to it. The order is placed when your head is clear. That's the version of you that should be making the decision, not the version that's watching a candle approach your stop in real time. Third, the trade journal. Record every trade, entry, stop, size, and how you felt when you entered. After 20 trades, the patterns are impossible to ignore. You'll see exactly when you sized up without justification, when you entered out of boredom, when you moved a stop, and what happened next. The journal makes your psychology visible, and visible problems are solvable problems. Let me show you what everything we've covered looks like when it runs as a single system. You're watching the market. You see a setup forming at a key support level. A reversal signal has just closed on the chart. Before you touch the buy button, here's the 60-second process. Layer 1, expectancy check. You open your trade journal and confirm your system stats. Win rate, 45%. Reward to risk target, 1 to 2. Expectancy, plus 0.35 R per trade. Your system has a positive edge. You continue. Layer 2, position sizing. Your account is $10,000. You're risking 1%, that's $100. Your stop loss is 20 points away from entry. One lot equals $10 per point. So one lot carries $200 of risk. Position size equals $100 divided by $200 equals 0.5 lots. That's your size. No guessing. Layer 3, drawdown check. You check your current drawdown from your recent peak. It's minus 8%. You're still within the safe zone. No need to reduce your position size. If it were minus 15%, you'd drop to 1.5% risk. If it were minus 25%, you'd drop to 1%. Layer 4, psychology check. 3 questions. What is the setup? A reversal signal at structural support. Clear. Where is the stop? At the structural low below the signal. Defined. What is the size? 0.5 lots. Calculated. All 3 answered in under 30 seconds. You place the bracket order immediately. Take profit and stop loss. Go in at the same time as the entry. The system is running. You close the screen. 60 seconds. No emotion involved. The system decided. Not your mood, not your confidence level, not how the last 3 trades went. Here's the full framework in one view. Layer 1, expectancy. Confirm positive edge using win rate and reward to risk. If negative, fix the system before anything else. Layer 2, position sizing. Account multiplied by risk percent, divided by stop loss distance. Fixed fractional, every trade, no exceptions. Layer 3, drawdown control, down 10% from peak, reduce risk to 1.5%. Down 20%, reduce to 1%. Down 30%. Stop trading entirely and review the system before returning. Layer 4, psychology system. The 30-second rule before every trade. Bracket orders placed immediately on entry. A trade journal that records every decision. Remove any one of these layers and the structure doesn't hold. Layer 1 without Layer 2 means you have an edge, but bet randomly. Layer 2 without Layer 3 means you size correctly until a drawdown destroys you. Layer 3 without Layer 4 means the rules exist, but emotion overrides them. And here's a 7-step checklist to run before every trade. 1. Higher time frame confirms the direction you're trading. 2. Your entry signal is clear. Not a feeling, not a guess. 3. Your stop loss is placed at the correct technical level. 4. Your position size equals account times risk percent, divided by stop distance. 5. Your reward to risk ratio is at least 1 to 1.5. 6. You've answered all 3 psychology questions in 30 seconds. 7. Your bracket order is placed the moment you enter. That checklist takes less than 2 minutes. Run it every time. No exceptions. Let's come back to where we started. A trader with a 68% win rate, 2 years of experience, a real system, blew 80% of his account in 3 weeks, not because his analysis failed him, because he had no system around the analysis. Now you know what that system looks like. 4 layers. A 60-second process before every trade. 7 checkpoints that take less than 2 minutes to run. This is what separates the traders who stay in the game from the ones who don't. The next time you're about to click buy, pause. Run through the checklist. Answer the 3 questions. Place the bracket order. That one habit, done consistently, puts you in the top 5% of traders. Not because it's complicated, because almost nobody does it every time. If this video helped you, subscribe. There's more coming on advanced position sizing, portfolio-level risk management, and how to build a quantitative edge into your system. And drop a comment. What's the biggest money management mistake you've ever made? I read everyone.